Today, we'll be talking about international acquisition strategies. It's very important to understand acquisition strategies. It's even more important to understand these in the context of international business, given the potential prominence that acquisition strategies have for the growth of any company, particularly one trying to catch up or move forward in international markets. Now, acquisition strategies in and of themselves are extremely complicated, and it is a topic that could well merit a module in and of itself. As such, given the complications and given the potential depth that we could have for the examination of this topic, I will be focusing on specifically a broad overview of two dimensions of international acquisitions. Number one are types of international acquisitions, to which I've identified as 5. And number two, towards the key strategic elements that need to be considered in any acquisition strategy. As you might imagine, for the second part, there are 2 key elements. Number 1 is formulation, and number 2 is implementation, each of which are equally challenging. Fortunately, our examination of the cases we'll be studying will help us go into that depth, but this breadth at least provides you with an overview of what we need to study. But even before that point, we need to consider a foundational element to acquisition strategy, which is essentially what are the critical questions we need to address when thinking about international acquisitions. And there are 2 simple things that we need to think about with M&A. Number 1 is the value creation the motivation for acquisitions? A lot of the perplexing evidence and a lot of the perplexing anecdotes about acquisition strategy emerge because they are undertaken for any number of different reasons, some of which might not create to the idea of value creation. My premise is that you will be undertaking acquisitions for the purpose of value creation, for augmenting value in both the acquirer and the target. If we do accept that premise, then we have to ask the question is, where is the value being created in the acquisition? And that's what the second part of this presentation will relate to, is identifying where the value will be created in the acquisition. But first, we must include the idea that maybe not all acquisitions are undertaken with the motivation for value creation. There could be multiple other motivations for acquisitions, some of which are connected or endogenous to the organizational structure and who owns a firm, and some of which might be related to the consequence objectives that come from variance in terms of who owns a firm and who controls the decisions. So related to that, I've identified 5 types of M&A motivations. Now, I'm not sure if these motivations are exhaustive of all possible motivations, but they are representative of what we do see happening in the acquisition space. So what are these 5 types of M&A motivations? Number 1 is a holding company. Number 2 is a financial M&A. Number 3 is a diversifying M&A. Number 4 is what I call the disciplined M&A. And number 5 is one we'll be focusing on at the end of the day, which is a value creation M&A. As you can see, these are almost graded in terms of their relative amount of focus on value creation. For a holding company at M&A, we assume there is no value creation motive. We simply do not put that on the table. We think it's done for other reasons, which I'll get to in the example I'll provide in a minute, but that is above and beyond value creation. A financial M&A is done for different sorts of reasons where there is some value creation, but it's not necessarily coming from synergy. It's coming from operating a set of assets in a more effective manner. So this is often what we see about the depressed or assets motivation, where someone comes in, buys a company, turns it around, and then sells it. A diversifying M&A can be building a company around neglected businesses, where maybe within another corporate structure, there's a set of businesses that aren't receiving attention, and therefore a company comes in to buy those assets, gives them the attention they require, and consequently unlocks the value that is in those assets, but only existing as potential when they are a neglected business. The third type is a disciplined M&A, which is similar to the first, but in this one, the company actually comes in, exerts stronger management control, and focuses more about squeezing something out of that company. Then the fifth one is the prototypical type of value creation, where we create value from synergy. And one of the things we'll be doing is thinking about, what does synergy actually mean? What does synergy actually mean? Because synergy is one of the most misused words in strategy. And because it is so misused, it is often abused and not understood well, and it's used as a catch-all for anything, and that's just wrong. We have to be able to specify what is synergy. And again, I'll be giving you a very clear example of that, and hopefully you'll be able to use some of these examples to work through your analyses that you'll have to be doing. Now, building a holding company. There's many, many examples, but one of the best examples that I've seen in Asia is AYALA Corporation. Now, this is AYALA Corporation from about 2 decades ago. And AYALA Corporation in the present day still has very much of a similar kind of structure. But let's just use this structure here because it's one of the simpler ones to understand. And it's also simpler to understand the implications of this kind of structure. All right. So what we have here is we have AYALA Corp, which is listed in the Philippines. AYALA Corp had, at one point in time, 4 main arms, or 4 main divisions, or 4 main businesses, plus a 5th division, the business called AC Capital. Those 4 main divisions were its company called AYALA Land, another one called BPI, or Bank of Philippine Islands, another one called Globe Telecom, and a third one called Manila Water, which I've called Manila H2O. What you can see in this simple diagram is a percentage of ownership of AYALA Corp in each of the constituent businesses. Now, the neat thing about AYALA Corporation is AYALA Corp itself, the parent holding company, is a listed company, and each of the 4 constituent businesses are also listed company. So 38% of AYALA Land's shares are floated in markets, and they have some larger and smaller shareholders. Same thing for Bank of Philippine Islands. Globe Telecom is also partially owned by minority shareholders, as well as Singtel Corporation, and so is Manila Water. The consequence of that is that we can understand what is the value of each of these companies as represented by their market capitalization. One of the other things that AYALA Corporation has done effectively in this kind of structure, when it bought and put together these assets to build a holding company, when it acquired each of these businesses, none of these businesses were developed independently by AYALA Corp except AYALA Land, is that even with a minority shareholding, they still have a controlling interest, so to speak. They still have a controlling stake in each of the individual businesses. So AYALA Land, BPI, Globe Telecom, Manila Water, and AC Capital are all run as AYALA Corp wants them to run. Now, the thing about this kind of structure is that it becomes expensive, right? This is AYALA Corp itself. Now, recall, AYALA Corp does not make anything. It just holds each of those individual businesses. This is an expensive structure because on top of all of those businesses, now we have an administrative structure where we have a chairman and the COO and the CEO who each have their own office, as well as other constituent entities within that corporation, that holding company, that costs something, but do not add any extra revenues, so to speak. All the revenues are generated by the constituent businesses, be they AYALA Land, Bank of Philippine Islands, Globe Telecom, Manila Water, and so forth. So as a consequence, we need those individual companies to generate value to support the cost of the holding company structure. The reality is that never ever does this holding company structure yield net gains in value. Maybe never ever is too strong a set of words, but certainly rarely is applicable. So what we often see emerging for companies that build by this kind of acquisition strategy, in other words, add individual businesses to create a holding company, is what we call a corporate discount. In the case of AYALA Corporation, this corporate discount can be determined by what we call the sum of the parts valuation. Sum of the parts valuation is simply seeing if the sum of the parts is equal to, greater than, or less than the value of the company as a whole, right? The value of the company as a whole is represented by the market capitalization of the holding company, which is AYALA Corp. Each of those individual parts has their own valuation, as I mentioned, because they're listed entities. So it's simply asking the question, does a market capitalization of AYALA Land plus BPI plus Globe Telecom plus Manila Water plus that last little small piece equal the market capitalization of AYALA Corp? It should, right? Because AYALA Corp is simply the sum of its parts. It's nothing more, nothing less. Unfortunately, yes, it is less. Yes, it is less. It actually trades, AYALA Corp trades at a 27% discount, or it did at that particular time, 27% discount relative to the value of the parts. Right? That means if you held the parts and allowed your money, if you distributed your shares of your capital in the parts as opposed to in the corporation, you would experience greater gain in your value as a shareholder, in the value of your holdings as a shareholder, through the parts and through the constituent company. And there's a variety of reasons for this. What's important is not the reasons at this particular time, although they'd be interesting to discuss. But what is notable is that within this particular structure, there's a 27% breakup premium, or what we call corporate discount, to the value of the holding company. This is unusually high. Usually we'd see about 10 or 15%. And again, there's a variety of reasons for this that aren't important. But the point of the matter is that holding companies are not there to create value within their individual businesses, even though people might say things from the corporate office to that extent. But the reality is the numbers always point to a different outcome. The next one we think about is the acquire distressed assets, turn around and sell the companies. AMC Theaters was in the news a lot these past few months because it was part of this fun little game we saw with the elevation in stock prices based upon Reddit and other kinds of communication channels. But even before then, when movie theaters were first facing some threats to their businesses, AMC became an attractive buyout candidate because at one point it was a premier movie theater chain in the US, but it was losing money. It was facing competitive threats from the emergence of home theater viewing and the emergence of streaming services and so forth. But what happened was that this private equity company saw an opportunity to come in and to reinvigorate the company. AMC was trading at lower multiples compared to its competitors, and it was deemed to be reasonable to be bought at $16 per share, and it could be pulled out of public listing, delisted, and either relist and sold through this idea of buying this distressed assets, disciplining the management, turning around and sell. So this slide now shows the details of the buyout of AMC Entertainment and all the transactions between JP Morgan and so forth, who were buying it for about $19.50, and then they financed it in various kinds of ways, and then they eventually sold it. But the whole point is that this acquisition is not done for value creation. It's just done to redefine what an asset is and then sell it to another company. At the end of the day, this company was resold to a large conglomerate from China, Dalian Wanda, the Wanda Group, who then eventually held on to this asset, and it went up and down in value. That's not really the point to gain. But the point is that this is another type of acquisition strategy, which was represented by the AMC movie theater chain, where they were not performing well. They were bought by a group of sponsors or PE or whatever you want to say. They reinvigorated the company, and then they sell it. So the idea is just is you find something that's trading at a valuation lower than what it should be, is underperforming. There's ways we can fix it, and then we sell it. That's another type of acquisition strategy, not oriented towards long-term performance improvements of the company that's buying it, more so just gaining control to redefine what that company is able to do. Then the next one, building a company around neglected businesses. This is largely what Tyco Global Networks was when it was part of the Tyco Group. Tactic Communications is coming in to see if they can turn around this business and make it into a better business. Clearly, Global Networks is not an important part of the Tyco company at this point in time. The question is, can Tata Communications Limited, can TCL turn it around? It's a neglected business. Are they able to improve that business? That's going to be the focus for our discussion in depth, so I won't spend a lot of time on it. but that's certainly another kind of acquisition strategy that can proceed. A fourth type of acquisition strategy is creating value from control. One of the things that we see happening in slow growth industries is acquisitions to consolidate. This happened in the cigarette or tobacco industry in the US, and it's been happening in the global beer industry worldwide as well. So what happened is just one of many acquisitions was Reynolds American acquiring this company called Lorillard. And what they're able to do is to create value from the control of these two companies through consolidating and through improving the performance. It's actually very similar to the synergy related arguments, but more here, the idea this is a horizontal acquisition between equal companies, and they're creating value through the shared control of these two companies, which allows them to make some real sensible improvements in the operations of these companies. This is also something very similar to what 3G Capital does out of Brazil, in terms of how they acquire companies, control them, and then redefine some of their operations, which is what they've done, for example, with Tim Hortons after they acquired it. Tim Hortons is a famous donut quick service food chain from Canada, where once the 3G Capital acquired control, they redefined how some of the franchisees and other operating companies or operating entities do business, and they try to extract value from that sense, from heightened control. Then the fifth type of one is create value from synergy. Create value from synergy. Here we have probably one of the most famous Countline chocolate brands in the world in the present day is Kit Kat, owned by Nestle. What some people might not know is that Kit Kat was originally created by a company out of the UK called Rowntree Corporation. When Nestle was trying to expand its product line, and it's done this many, many times in a way analogous to what I'm describing with Kit Kat, when Nestle was trying to expand its product lines into confectionaries and into Countline chocolates, it identified Kit Kat and Rowntree as a potential acquisition target. At the time that Kit Kat was being chased, or Rowntree, pardon me, was being chased by Nestle, it was underperforming. It had had several years of poor performance, which was reflected in a depressed stock price. And as a consequence, and of it being a listed company, it became an acquisition target. It was put into play. At the time that Nestle was approaching Rowntree, Jacob Suchard, which was another company from Switzerland, was also approaching it, and there was a bit of a bidding war, and eventually Nestle was able to win the bidding war, probably for two reasons. Not probably, but specifically for two reasons. Number one is they had a much more attuned approach to the acquisition, in the sense that they were communicating clearly with the Rowntree managers to explain what the company would look like, that is Rowntree in Nestle, what the company would look like post-acquisition. And so the target's managers were necessarily concerned about what their appearance would be in the company post-acquisition, what their jobs would be like, what the organization would be like, and so forth. And then the second reason was that the synergy created for Nestle by acquiring Rowntree was greater than that created for Jacob Suchard by purchasing Rowntree. So as a consequence, with a greater synergy, Nestle should necessarily be willing to pay more. So where was this synergy created? This synergy is created because of the strategic logic behind the value creation. And we always have to look at the strategic logic to identify where there's value created in an acquisition. So we think about this motivation for Nestle. Okay, think about this motivation for Nestle as displayed by this strategic logic slide. First of all, they want to enter the Countline market in chocolates. There's box chocolates, Countline, for example, and block chocolate. These are the three brands of chocolate. Countline and block chocolate, box chocolate is not growing. And so as a consequence, they want to move into the growth market, which is the Countline. Countline is a growth market. So this is what they want to achieve. But the problem is that they don't have any Countline brands. This is Nestle, right? And moreover, it's really difficult to make a new brand in chocolate space. There's no really new formulations. There's no really new techniques. It just happens to be, can we be lucky enough to build a brand? And then once we establish that brand, we take time to build it out. So the best thing to do is to actually buy a brand or buy a company that has a series of brands, such as Roundtree with Kit Kat and other brands. Other potential companies could have been Cadbury, for example, or Hershey, but Hershey was a private company at this particular time. But all of those, but that was the way to move into this market. There is really no make option, so you have to buy. And when you're buying, you can't really ally. So you need to make this acquisition. Nestle wants to make this acquisition. And how are they going to support the price of the acquisition? Very simply, they're buying a tremendous brand. They're buying a tremendous brand in Kit Kat and the other ones that Roundtree had. But Roundtree had primarily a presence in the UK and secondarily a presence in Europe. Thirdly, not much else, nowhere else in the world. But Nestle, as a global corporation, had a presence everywhere in the world, or not everywhere in the world, but maybe most places in the world. So the synergy is simple. You have this great brand that you can plug into this big distribution system, and all of a sudden you have Kit Kats flowing to so many more markets in the world. This is a nice complementarity in assets that create synergy. You combine a good brand with a good distribution system. Prior to this acquisition coming together, you have a good brand, weak distribution system on one side, which is Roundtree. On the other side, you have Nestle with a great distribution system, but no brands. Merge these two together, you have classic synergy. The synergy is value creation through revenue augmentation by linking together these assets, right? So that's really what we want to explore whenever we're looking at an acquisition strategy under category number 5, which is value creation. What is the strategic logic for this acquisition? Why does the acquirer want to buy the target? And number 2, where's the source of value creation? You have to be able to articulate the source of value creation to justify this form of acquisition. If you cannot articulate it, then maybe there is no value creation. And this is so critical to this process. You have to be able to do this. As a consequence, whenever we see a value creation M&A, we ask this key question: where is the value created? Where is the value created? If this question cannot be answered, then maybe there's no value created and we should not be considering this acquisition at all. We have tools to help us articulate where there's value creation in this type of acquisition. And this is what's part of our M&A strategic framework, is to reveal these kinds of tools. We have to think about, first of all, what's the motives, what we just talked about. There's potentially 5 motives for the acquisition. If they're number 1, number 2, maybe we don't really care so much about long-term value creation or the merger of these companies. If it's 3, 4, and 5, then we have some idea of value creation. If there is value creation motive, what's the strategic logic? Does that really align with the idea that there's value creation? And then finally, the last step, but not really the last step, but it is sometimes conceived as the last step, but when it's conceived as the last step, it's a mistake, is what about the integration? Now, why I say it's a mistake to call it the last step is actually we should be thinking about integration early in the process, but I'll define more of that in a few minutes. But we have to think about motives, then we have to think about value creation, then we have to think about integration, or what we might call the implementation plan. All right. So how do we put all this together? First of all, let's think about what a typical M&A transaction looks like. Typical M&A transaction is the acquirer is bigger than the target, about 20 times larger than the target. Post-acquisition, the acquirer's management controls both the acquirer and the target. Why should the acquirer be larger than the target? Number 1 is this simple concept of digestibility. The acquirer is ingesting the target. It's easy to add small pieces, but if it's a very large target, it's not really digestible. It becomes difficult to merge into the acquirer. That's why merger of equals sometimes can be so difficult, because you're putting together 2 substantially large organizations and disturbing both of them. If the acquirer is much larger than the target, then the target can be folded into the acquiring company without too much disruption to it. We do know generally there's value creation, but we also know that the target shareholders tend to be the principal beneficiaries. In other words, there's a premium being paid for the target. Sorry, the target shareholders are the beneficiaries. There's a premium being paid, often 30 to 60% of the target's value. For the acquirer, often their share price doesn't move, or maybe it goes down a little bit. Okay? The net market response is positive, but the returns are asymmetric, meaning that the target shareholders gain immediately, the acquirer's shareholders don't gain as much. Eventually, what happens? Often we don't see long-term performance of the companies improving. 2 reasons for that, as connected to the framework, or maybe even 3 reasons. Number 1, maybe there was never that motivation for the performance to improve. Number 2, if there was value creation, maybe the strategic logic was flawed. Most likely, number 3, implementation was just not handled as well as it could be. We actually know number 3 is an operative explanation, because we do see for companies who are serial acquirers that they tend to perform better the farther they progress in the acquisition process. This suggests there's learning in the process about both valuation, but more importantly about how to structure the integration. And a lot of these companies actually set up a separate team to handle the M&A process, so they know the ins and outs of the process and some of the pitfalls that are involved. We can think about these strategic elements again: strategy, pricing, implementation. Now I've separated pricing here because that tends to be a critical element, and we don't want the pricing to get to the point where it subverts all value within the acquisition. Again, strategy. Is there value creation? Will there be vertical integration? Is there industry consolidation? A lot of things that might be considered within the objectives. How are we going to undertake the pricing? Are we engaged in a bidding war? Jakob Suchard and Nestle were actually in a bidding war for Roundtree before Nestle's managers stepped aside and said, hey, we can't do this. Let's talk to Roundtree, get them to agree on what's a suitable bid price that they can endorse, and therefore kind of cap the price that they pay at a reasonable level. In a bidding war, the winner loses because the winner only wins because the second company is not willing to bid anymore, which means the prices become too expensive, right? So that's often the concern about a bidding war. Then how do we pay? Is it we're going to exchange shares? Are we going to give cash? Are we going to use the retained earnings of the acquired company to pay for some of the acquisition and so forth? Then implementation, lots of issues. What's the structure? What's the culture? What kind of incentives do we give? What's the pace that we go through? What are the objectives, excess resources, all sorts of issues that are common to strategy implementation in general, but also can be specific to acquisition integration as well. When we think about all of these together, we think about the challenges being manifest by the items in this chart. Okay, here's the costs. The costs are, first of all, what's the target's value? Then what's the premium we're paying, which is part of the pricing? What are the transaction costs? We have to pay the lawyers, it costs company time and so forth. Then there's going to be integration costs. Maybe we have to lay off some people. Maybe there's other things we have to be able to do, but there's going to be certain costs associated with that. At the end of the day, the target's cost to the acquiring company is much greater than the value. As a consequence, we need synergy to cover that differentiation, just to break even, so to speak. But we don't want to break even, we want to profit above and beyond that. So this is why, first of all, controlling costs is so important, because that limits the amount of synergy that we need to be able to justify those costs. Then the second thing is we need some kind of estimate, reasonable estimate of where the synergy will be and what will be the value in that synergy. So to do this, we turn to the simple profit function of the firm to identify the synergy. We can say the NPV, the net present value of an acquisition, is simply the synergy less the premium plus other implementation costs. Right? If that's a negative value, then we have a problem. Now, what is synergy? Synergy is simply the value of the acquirer and target together as one entity, less the value of each individually, right? Less the value of each. And that's clearly when we talk about synergy, we're always thinking about things that are coming together. Where can synergy come from? That's the critical point, right? So we have the logic of the first 2 lines. Where can synergy come from? There's 3 sources of synergy, pardon me, right? And that comes from the profit function of a firm. Profit is simply a function of units sold times margin, where margin is defined as price less cost, right? So number one is we can increase our sales. This is the Nestle Roundtree example. Revenue growth due to complementarities. We can keep the same margin and just simply sell a lot more of the products. Nestle plugged Roundtree's products like Kit Kat into their distribution system. Boom, revenues expanded tremendously. And they're still expanding to the present day, as you see through the proliferation of Kit Kat brands, which is more brand extension in the present day, based on partly premised upon Nestle's marketing might. But still, it's the idea that revenues are exploding due to growth and complementarities. At the other end, we can cut costs. These can be due to gaining economies of scale or economies of scope, or what we might call rationalization economies, where duplicate functions between the acquirer and target are eliminated. That's often some of the downsides of acquisitions, where there might be job losses as a consequence of pursuing those rationalization economies, which is a much nicer set of words than job losses. But at the end of the day, they relate to reducing costs. The last one is seldom, which is the middle one presenting here, which is seldom actually seen because it's guarded against by regulators and antitrust regulations, is an increase in the ability to price based upon a consolidation of market power. That's not typically realized in an acquisition, although it is possible, but it would require substantial consolidation of the market to yield that pricing power, where the pricing is done independent of supply, of where supply demand converges in the market. In other words, its ability to extract more consumer surplus, so to speak. This is again typically guarded against. Where an example of how it's guarded against is in the US market, when Budweiser, or not Budweiser, but pardon me, AB InBev acquired Corona beer, which is owned by Grupo Modelo in Mexico. They were not allowed to sell Grupo Modelo's products in the US because that would have led to AB InBev having more than a 50% market share in the mass market beer industry in the US. So as a condition for that acquisition to be improved, Grupo Modelo's beer brands were controlled by Constellation Brands in the US, although AB InBev could sell those same products elsewhere in the world. Again, the reasoning is that there was a desire not to have so much consolidation in one company, by one company in the beer market in the US, such that they might have pricing power. Okay, continuing on, lots of specific types of synergies. You can see reductions in overhead through headcount reductions and so forth. I leave it for you to kind of look at this slide, think about where there's just cost synergies, where there's revenue and growth synergies. But again, these must be articulated. The starting point is in the previous slide, and looking to say, hey, simply, where are we going to create value? Are we going to increase our revenues through selling more? Are we going to increase our margins? Increase our margins by cutting costs? If so, where are those costs going to be reduced? Or are we going to be able to price more aggressively in the market, right? So we have to identify those synergies. Without identifying those synergies, we have a problem. Finally, the last steps are thinking about implementation. Now, implementation is a big, big topic. Maybe we'll have some chance to discuss it in more detail. But one of the things is we have to make acquisitions into a routine. Like any other function within a company, it becomes more effective when we become more experienced at it, and we learn from that experience to become more skillful. How can we do this? First of all, don't bet the farm on the first deal. Why do a very, very large deal first when you can do several small deals? Learn, understand how to do diligence. Understand whether your strategic rationales are valued. Understand where you have weaknesses and strengths in the organization. Start to build up the internal documentation, such as a due diligence checklist and other items. Start to build your team who becomes skilled at the process, and think about how this team fits into the broader organizational structure so that they have control and respect to be able to guide other units in the acquisition department. How can you establish the relationships organizationally between your acquisition team and each and the other BUs in the organization? And then use what you learned to guide the post-acquisition integration process. identify the areas that need to be managed and what your process will be to the process. People often look at M&A steps as being linear, which I've kind of said, from the planning, courtship, bids, signing, processing, and integration, when they don't have to be linear. They can be they don't have to be sequential. Again, this is showing that they're linear, where we have the target selection, due diligence, negotiate structure, integration planning, and then integration, where we suggest we're just passing the deal down the organization to different groups of people. But critically, this should not necessarily be linear, because there could be problems in the process at challenges in the process of acquisition that could stop the value being realized that might not be seen by people earlier in the deal, in the process. So maybe the target looks like a great target. Maybe the deal is terrific. Maybe the strategic logic works, but for whatever reason, the integration will not work. So what we can conceive of is that we can work collectively across these different areas of target selection, diligence, and integration planning. We can do these all at the same time, or roughly at the same time, before negotiating and structuring the deal, and then actually going through the integration process, so that we're aware of the full set, or at least we're more manifestly aware of some of the challenges in the whole acquisition process, such that we can construct a better deal and have a greater chance of actually realizing the gains of the acquisition that we anticipate. So this is one of the critical steps that I think companies have considered more recently that have facilitated the ability to do acquisitions well, which is, don't think of it as a linear process. Think of it as a collection of processes that need to be managed collectively, again, collectively at the same time. Finally, the other thing is to create authority in the organization. And this is one of the most interesting things that we've seen in a lot of the new economy companies, is they create a new role called the Corporate Development Executive, or CDE. This person resorts as part of the TMT. They report directly to the CEO, and they're dedicated to leading M&A and inorganic growth inside the organization. So it's not just an M&A team. You also have that M&A team having an individual who leads the execution and coordination of all tasks in the M&A life cycle. They think about the sourcing, the execution, the deal completion, the merger and acquisition, the integration, all under the idea that there has to be value creation. All under the idea there has to be value creation. These companies, such as IBM, Apple, Airbnb, Twitter, who have been growing very, very quickly, and often by acquiring different pieces, they all have this kind of CDE, the CDE. What we see with these companies, and this was by research by one of our faculty done at NUS, what she has been able to find is that when CDEs are involved in 30, 40, 50 deals, which is quite a few, but that's why I say this process has to be built into a routine. When they've been involved in so many deals, the actual ability to yield positive value from the acquisition begins to increase. So the summary or takeaway point is that when you have a process in place to build the routine and skills in the organization, as you do for any other function, to deal with the challenges of the acquisition process, you have a much better chance of actually realizing value and avoiding the mistakes and pitfalls that are so commonly talked about when discussing M&As. Right? So what do you think about the CDE? Again, there's someone who's charged with a very considerable scope. They drive all aspects of the deal execution. And again, I won't talk about each of these individual points within this slide. I'll leave them there for you to view. But again, this relates to the idea the acquisition process is not a series of steps to be handed down the firm to lead to the final integration of the target within the acquired firm. It's a whole series of functions that must be managed jointly. And when you put it within one unit as led by CDE or a person from the TMT who's charged that responsibility, then you actually have a real opportunity to make it a success. Now, that CDE is in the companies that are going to be going through a number of different acquisitions over time. But the bigger point, I think, to take away from this is that, hey, this process can be managed. And whether we're doing one or two acquisitions, or our first or second acquisitions, or whether we're a serial acquirer, there's certain organizational steps that can lead us to have greater success in both identifying a strategic logic for the acquisitions, ground testing that logic to see if it really holds water, that it will be a source of value creation, and then thinking seriously and concretely about the implementation or integration challenges that will be encountered, and then identifying what those challenges are or what the process should be such that we can have an effective merger, right? So we can think about it again. The foundation for successful M&As, as in any growth strategy or with any strategy, begins with leadership. Leaders must lead. They must formulate and implement and take charge of the process. We must also be realistic about the sources of synergy. We must be realistic about the sources of synergy. We must identify the sources of value creation. These are not sound bites that go on the news. These are serious considerations about where we are going to create value. Then we must also understand that integration is going to be more difficult than we anticipate until we have experience with multiple types of integration, so that we really understand the time and costs required. We really understand the time and costs required. Then, if we're going to make this an important function for growth within the firm, establish a team or unit and build leadership with responsibility in that unit. Establish a team or unit to guide the full M&A process and have that team headed by somebody with equal corporate legitimacy and responsibilities as others within the TMT. Put all these pieces together and you have a great chance to make M&As a successful function for your growth strategy into international markets. Thank you very much.